Hello everyone and welcome to another edition of Meet the Investor. My name is Joey Murakade, Senior Investment Director at Stanford Brown. Joining me today is Scott Radke, CEO and co-CIO of New Holland Capital, a multi-billion-dollar hedge fund manager that has been servicing a global client base of institutions and wealthy clients for nearly 20 years. Thank you for being with us today, Scott.
Thanks for having me, Joey.
I was wondering if we could start with you giving us a little bit of background, firstly on yourself and your career, and then telling us a little bit about New Holland, how it started, what the idea was behind it, and what New Holland mainly does now.
I actually started my career in engineering and working in manufacturing and pivoted over to finance, almost 30 years ago at this point, initially in investment banking. But in 2005, I joined a Dutch pension fund in their absolute return group. And this was the group that eventually spun out a few years after I joined to become New Holland Capital. And that really forms the core of what New Holland is all about, and what we've always been focused on, which is trying to create a portfolio that is diversifying relative to the other assets that our clients hold. I call this investing for the other 95%. And what I mean by that is for the Dutch portfolio, we've always been around 5% of their assets. But the goal was to never optimize our 5%. It was always around figuring out what we could do to have the biggest marginal contribution to the rest, the other 95%. And the way we do that is through this dual mandate of, on the one hand, return generation, but equally important is risk management, ensuring that our portfolio is not susceptible to very large drawdowns in these correlated market environments. When there are big equity market crashes, that's when we need to ensure that we have adequate diversification in our portfolio. So that's really the DNA of New Holland Capital. In 2020, we started investing on behalf of other clients, both institutions and family offices, wealthy individuals. And today we're doing so in a variety of different strategies, most notably in a liquid multi-strategy product.
Thanks, Scott. So you touched on a bit of terminology there in terms of hedge fund strategies. Can we just take a step back for investors new to the hedge fund space and talk about the hedge fund universe and the different strategies that are available and what within there New Holland sort of gets involved in?
Hedge funds, in a way, is a pretty unhelpful term. It's really more of a style of investing than anything else, where we're trying to invest in a way where we're not making a bet on the direction of markets, for example, the way you would with a long-term equity allocation. Instead, a lot of the investments that we're making are predicated more based on relative value. For example, the price of copper in Europe versus Asia, or maybe the price of one equity in a particular market segment versus another, where we're hoping one is going to go up in price and the other down. So that's the hedge part, obviously, of hedge fund. The classic hedge fund strategy, and really the first, was an equity market neutral strategy, equity long short, where you're buying the stocks you think are going to go up, and you're selling or shorting the ones that you think are going to go down. So it's that ability to short or hedge, which really makes hedge funds quite different than just a passive equity allocation. As it turns out at New Holland, we tend to de-emphasize that strategy. It's really well populated. There's a lot of capital pursuing it. It's highly competitive. And our preference has been for quite some time more esoteric, often more capacity constrained strategies. So an example might be like the one I gave a moment ago, a commodity relative value, where we're trading different commodities against each other, or volatility trading, where we're assessing volatility in, say, equities and trading those single name equities against baskets of equities. So it tends to be some more obscure things in the capital markets, but done so globally across all strategies, equities, fixed income, commodities, currencies, et cetera. So it's really quite a breadth of activities that we're looking at.
So staying high level with hedge funds generally, they sometimes get a bit of a bad rap. and I'll read out a couple of generalizations that they're opaque and black box. You don't really understand the strategies that they are running. Ultimately, you've given us a few type of strategies they do, but an investor may not know what the details of those strategies. They don't necessarily outperform typical investments in the share market, and they can be very expensive, with hedge fund managers making a lot of money at the expense of investors. I'm not expecting you to defend the whole industry there, and I tend to agree with those comments for certain hedge funds, but how would New Holland see themselves as different to that?
Let's start by saying I think a lot of hedge funds deserve a bad rap. They haven't delivered what's on the tin, which is good risk-adjusted returns with diversifying exposure that doesn't draw down a lot in market crises. So I think a big part of it is the selection of which strategies and which portfolio managers to execute those strategies. You focused on three complaints, and we hear those from our client base as well. So I thought I'd just maybe touch on each in turn. First, with respect to black box and opacity, I think this is really a selection issue. Some hedge fund strategies are difficult to understand, but if you invest the time, you can do so. And we have a dedicated team of more than a dozen investment professionals just for that purpose. And we won't invest in strategies that we feel like we can't get our arms around because oftentimes the PM won't provide sufficient information. So I think this one can be overcome with a combination of work and selection. The second issue you mentioned is underperformance relative to equities. And I think this one is a little misguided in the sense that I think it misses the point of hedge funds. I think hedge funds will and should be expected to underperform equities when equities are doing exceptionally well. When there's a really strong bull market, hedge funds should underperform them. Similarly, they should outperform equities when equities are having a tough go. That's the diversification. If they performed exactly like equities, they wouldn't be all that valuable to your portfolio. So here, I think the common comparison that you see in the financial press, in a way, obscures the purpose of the portfolio construction value for hedge funds. That doesn't get them off the hook entirely. They have to generate decent returns over the cycle. But I just think that spot comparison to equities is a little bit misguided. And the last one is about fees. And I think the issue here is in some ways less about fees and it's more about the value add delivered. The comparison that comes to mind is if you went out to eat at an upscale restaurant, if you had a delicious meal that had inventive cuisine and exceptional service, you wouldn't feel badly about having paid a premium price for it because you got a premium product. It's only if the restaurant failed to deliver that you'd feel like there was bad value. And I think the same is true with hedge funds. If they do lose a bunch of money in bad equity markets, if they fail to deliver good returns over the fullness of time, then I think they are expensive and they don't deserve a role in your portfolio. But I do think that for alternatives generally, which on average tend to have higher fees than more passive investment strategies, if they deliver exceptional value, then it's worth it.
Okay, so deep diving a little bit more into New Holland, you talked about allocating to different strategies and managers. How exactly does the mechanism of that work?
Yeah, so it starts by scouring the globe for really talented, experienced portfolio managers. So these are folks who have histories of investing in their particular sub-strategy. We're usually looking for folks who are pursuing a niche area. One example that comes to mind is a agricultural PM trading soy, wheat, corn, and cattle in the U.S. markets. Farming background, long history in trading those both on an absolute basis and relative to each other. For example, corn versus soybean. So we're looking for folks who have a deep expertise in their area and where there's some demonstrable uh, evidence of alpha or value creation. And sometimes that comes in the form of a track record, which is helpful. But look, we've all seen that past results are no prediction of the future. We also are looking usually to see some sort of common sense explanation for why it might be the case that alpha generation over time is possible. It's a really difficult game in financial markets with a lot of really qualified people playing them, so that when you feel like you found a PM that is going to be able to generate good returns over the cycle, that's a pretty audacious statement, and we want good evidence to back that up. New Holland can be a preferred place for PMs to go. We have a strong reputation, having done this for a really long time, as a stable, patient source of capital. That doesn't mean that we let poor performance slide. We'll cut people from the portfolio if they underperform. That's part of the model. But we do so in a way where it is a reasoned, thoughtful decision made by investment professionals who are intimately knowledgeable about the portfolio. So I think the other side feels like they're going to get a fair hearing. It doesn't mean it'll go their way, but at least when push comes to shove, they'll be talking to somebody who understands what they do on the other side. So it's really about working our network and those of our counterparties, like the investment banks with whom we have relationships, to try to access the biggest pool of talent, the biggest grouping of PMs we can get on the top of the funnel, and then filtering them in the ways that I've described, including finding folks not just with evidence of alpha creation, but also those who have an alignment with what we're trying to do on the risk side. I keep mentioning the two together because they're equally important. So it's important that we find a common ground on both.
So just touching on those mechanics, you, rather than investing in understanding in direct underlying hedge funds where these portfolio managers reside, you sort of allocate money to them in a different way and see all their positions and are able to aggregate all the portfolio manager positions up towards you. So you don't allocate to funds and you don't necessarily hire these portfolio managers directly to work for New Holland. Is that right? And how exactly does that work? And what's the advantage of doing that in the way that you do from a risk perspective?
Yeah, what you described is exactly right. So New Holland Capital runs the portfolio, and then we give risk budget to right now around 40 different portfolio managers in the tactical alpha strategy that we run. And as you said, we don't invest in their fund. Instead, they trade on behalf of our balance sheet, the balance sheet that we control. Correspondingly, we see their positions every single day. So we're able to run our own independent risk management on them. We understand how they're set up, where the P&L is being generated from, what the risks are in the portfolio. And those are one of the big advantages, is a great deal of transparency. You talked about opacity being one of the criticisms of hedge funds. Well, we have full position level transparency on every PM every single day. So that gives us a great deal of raw material from which to draw insights, both about how PMs are set up, but also how they're making money. The other benefit is that it allows us to be much more capital efficient. And without getting into the gory details, I just say that it is a lot more efficient to have a big pool of diversified risk and seek to gain leverage on that pool rather than seeking leverage on individual sleeves of assets from each of the managers independently. So by harnessing the diversification that is inherent within the portfolio, we work really hard to find portfolio managers that are very lowly correlated to each other. One of the benefits is that we're able to access less expensive and more attractive leverage to amplify the returns that we generate in the portfolio.
So let's take the example of, one of your strategies which allocates to 40 different portfolio managers. Presumably some within that group may be more consistently high returning and lower risk and performing in ways over a period of time where you feel like they might well be the superstars amongst the group, for example. What's the temptation to allocate more and more to that type of manager, and how do you manage that temptation to not do that?
To a limited extent. I mean, clearly you want to upweight your winners and downweight and eventually eliminate your losers. So there's an element of what you described to the model. But on the upweighting side, it can only go so far. As I've described, a key to the process, to the whole structure, is diversification across strategies, across PMs, geographies, etc., so that you can never let any single PM get too large in the context of the overall risk budget for the strategy. So that's really the upper bound, and that discipline is just inherent in what we do. To deviate from that would really to go stray from the fundamental foundation of the multi-strategy approach. But on the other hand, we definitely upweight the guys who seem like they're having a better time of it, because sometimes that's good evidence of an attractive market environment for what they're doing. So while we won't let any one PM get too big, we will seek to, with some strategies where we feel like we have some ability to assess the near-term opportunity set, seek to upweight them when they're interesting and then downweight them when they normalize. And that variability in the opportunity set, and therefore our capital allocation, I think is an important source of incremental return associated with how we can manage that portfolio.
I suppose one of the difficulties in any investor really appreciating the value add and the returns over time, and the sources of those, can be in the lack of, I guess the difference between what a hedge fund strategy is and just normal share markets and, anything linked to interest rates or bond markets or anything like that. From your perspective, when you're looking at the trading that these managers are doing, and they, particularly the good ones that might have an off month or two, how do you know when is time to cut your losses, given that you may not necessarily know whether they're just having a short-term sort of blip, because I presume not every manager can make money every single day and every single week and month, and whether it's time to sort of, remove or reduce allocation to those guys at what point? It must be difficult to see that transparency and make those decisions.
Yeah, you're right to point out that hedge fund strategies do not generate returns in some linear, steady fashion. They experience losses, they experience moments of outsized gains, and there's a lot in between those two. So a big part of our job, both before we make an allocation and then after, is trying to disentangle why a PM is generating the returns that they are, and to try to distinguish between luck and skill. That's equally true whether it's profits or losses. I know your question was framed in the form of losses, but we'll interrogate big gains just as much, in the belief that if you have big unexplained gains, that could just mean you got lucky, and they could have just as easily been big unexplained losses. So the kinds of things that we'll do is to understand, well, first, what is the strategy that the PM is pursuing, and what are the conditions underlying it? As an example, if a manager is investing in new stock offerings, initial public offerings, IPOs, or secondaries, there's a lot of data out there about the amount of IPOs and how they've been doing overall. So you can see, is it a good market environment for their activity, or is it a more subdued environment? Similarly, a big part of network maintenance is not just sourcing the way we talked about a minute ago, but it's also understanding how other folks who pursue similar strategies are doing. So if everyone in a particular strategy is doing poorly, that helps you contextualize how the particular PM in your portfolio is doing. Finally, you're getting into the granular thesis behind key positions and understanding what did they think was going to happen, what happened, did that generate profit or loss, was it their thesis coming true, or did they just get bailed out by a lucky outcome or get stung by an unlucky one? So having touch points with the PM about the portfolio ahead of whatever resolution happens to the individual positions is important, so that you can hear the story before the final chapter is written, which then helps you interpret the numerical results that come out of it. In the end, you're left not with an answer, but more of a mosaic, which you then piece together to try to make some determinations. And usually the right answer is to do things gradually. In other words, if you're gaining conviction at a PM, you should probably gradually increase their risk budget within the bounds that we talked about before in terms of ensuring adequate diversification. And similarly, if you're losing confidence in a PM, it's probably not the right answer to go from a full allocation to no allocation overnight. But there are certainly moments when that rule is not true. If there's some risk in the portfolio or unexplained P&L that's just outside of your underwriting, then probably the right thing to do is just get out in whole and move on if it feels like you don't understand why the portfolio is behaving as it is, or if there's a risk factor that we hadn't been appropriately considering that seems really material, or maybe there was a change in the PM, a key person event. These are the circumstances in which we would exit quite quickly. But usually this whole luck versus skill determination is really the biggest part of the job, made more difficult by the inevitable and inherent volatility that hedge funds returns experience over time.
So looking ahead, what's market scenarios and outcomes would be good or bad for a multi-strategy manager like New Holland? And in that, I'm thinking, broad equity markets going up or down, interest rate cycles, higher volatility across those different asset classes, inflationary, non-inflationary environments. Can you comment on what type of environments would do well and not so well for a strategy like this?
If we do our job right, none of the things you said should matter very much. In other words, we shouldn't have much exposure to directional equities, rates, FX, etc. That's not what our portfolio is supposed to do. We know our clients have that exposure elsewhere. That's the other 95. So our job is to try to generate returns in a different way. And a lot of our work from a portfolio construction perspective is about how to put together the pieces so that what I said is true. Take a volatile market environment. That really helps some strategies, more short-term trading-based strategies like macro, where you're making bets on rates or foreign exchange, et cetera. More volatility helps. On the other hand, a quiet, calmer market helps most arbitrage strategies, where you're hoping that two similarly priced instruments, the price of them converge to fair value. So we want to have balance in the portfolio between strategies that do well in highly volatile markets and those that do well in more subdued markets. So it's a bit like, back to the cooking analogy, you have the ingredients, which are the different PMs, but how you mix them together and how you weight them is crucial to constructing the risk and return characteristics that we're seeking in the portfolio. And one of those is minimal exposure or beta to these standard market factors. But there's obviously a limit to all this. I would say that a difficult environment was when the Fed and other central banks were really suppressing market volatility by having a zero interest rate policy. That was a really abnormal period in markets. So it's refreshing that we've emerged from that. We're seeing divergent central bank activity now. We're seeing inflation be a material consideration. We're seeing the Fed, for example, no longer play such a prominent role in markets, and their balance sheet is shrinking, not expanding. So these are the bellwethers for a better environment for alpha creation than what we experienced previously. So we're more enthusiastic about that as a result.
And on what you just described, maybe I'll finish with a cheeky question. You've sort of highlighted that the returns are pretty solid for the strategies that you run. The risk is mitigated somewhat, and the strategies are expected to perform almost regardless of the market environment. Why wouldn't investors see all that? It sounds like almost a holy grail of solid returns with low risk and through most market environments, and allocate far more than the sort of 5% as an example that you alluded to into a strategy like yours or the ones that you run?
I think hedge funds are scary to many investors. I said that we understand what's going on underneath the hood, and that's true, but it does take work, and I think some investors shy away from that. When we look at our client base, they're looking for hedge funds to play a particular role in the portfolio. It's not going to be the highest returning asset they have. And though I've talked a lot about diversification today, we will lose money, albeit a lot less than equities, in severe market crashes. So hedge funds are a little bit of a complicated story. It's like an athlete who's maybe not exceptional in any one thing, but is valuable because they can do a lot of things pretty well. And that's, I think, the role of hedge funds. Good diversification, but not perfect. We don't make money in a crisis. Good returns, but as we've said, in a bull market, equities will outperform hedge funds. So in some ways, no matter what happens, you can look at your hedge fund portfolio and say, I don't know, like, why did I own that? And I think it really takes a more considered portfolio construction viewpoint to really see the value of hedge funds in the portfolio. And that suits just a subset of investors who think that way and are really in the stay rich club as opposed to the get rich club.
Scott, that was fascinating. Thank you for sharing your thoughts on all of that.
Thanks for having me.